Some policy trends. First up, let's bring in our market all-stars. Jerry Bowyer, Quentin Hardy, Stephen Abrams, Andrew Bush. Tough day in the stock market. Let me ask, just to have some fun, Jerry Bowyer, is there any linkage between the Michigan primary and today's stock market plunge? Is such a thing possible?
No, but there were no solutions out of Michigan either. So there was no glorious McCain tax plan that was going to solve all this problem. No, I mean, today was about the numbers. Today was about seeing retail number headlines with a negative, with a number with a negative sign in front of it, and everyone hit the recession panic button.
All right, so Stephen Abrams, I hear you've hit the panic button. I hear you've changed from the world's greatest bull to the world's biggest bear. That could be one of the greatest flip-flops since Mitt Romney started running for president, Stephen Abrams. What's on your mind this evening, buddy? You're not panicking over one number, are you?
Well, Larry, you and I haven't been together for a couple of weeks, but as John Maynard Keynes famously said, when the facts change, I change my mind. What do you do? Now, look, the evidence of the last several weeks has been most discouraging, to say the very least. And I only want to make one simple point here, and that is that whereas stocks were continuously underpriced from 2003 to 2007, underpriced relative to the continuous stream of upside earnings surprises, the reverse is now true. Stocks are currently overvalued relative to the earnings you're going to see over the next few quarters.
I just don't see
and
how.
You're going to have to
how do you
let
make
it play
that judgment?
out.
How do you make that judgment, given the fact that stocks and profits are not a static moment, and you've got falling, one might even say collapsing interest rates? You've got a 10-year rate of less than 370. You know the Fed funds rate is going down another 50 basis points real soon, and then probably another 50 after that. In other words, I would say to you, Stephen Abrams, outside of financials, relative to expected profits in the rest of the spectrum, discounted by these low interest rates, Stephen Abrams, I don't see what the hassle's all about.
No, I'm terribly sorry, my dear friend. If you listen as I do to one after another downgrade of earnings expectations, one industry after another, one company after another, you just can't ignore the evidence that's right in your face.
And Quentin Hardy, are you going to agree with this bearish view?
Well, Larry, I haven't changed my position. Unfortunately, it's been a negative position. And since Santa left the building about 3 weeks ago, this stock market's vomited up about $800 billion in value. That can't make you feel very good, can it?
No.
Now, you can talk about interest rates, and you can talk about bond yields and all the other things. But when it comes to corporate profits, here's what I like. Intel showed up today, bad. Retail numbers, bad. That's what I call an indicator. That's going to hit the bottom line. In fact, that is bad earnings right in your face.
Intel's number was up 51%. Intel was up 51%.
It's a projection. It is mispriced to the market.
Andy Bush, give me some help here, buddy.
It's not the fourth quarter,
Andy Bush,
Larry.
give me some help. Give me some help
I'll tell you what.
Because I want to ask you, Andy Bush, you're in the pits, you're trading, you're making these decisions. You're not really an academic the way some of these other people are. I want to ask you, why isn't this a seller's capitulation? It has all the earmarks of a capitulation, Andy.
Oh, Larry.
Well, I'd say on a technical basis, you're looking at 11,900 for the Dow. We were looking at some charts today, and I think that's where we're going to end up heading to. But from there, I really like it to go back. The reason being is because, as you mentioned, the Fed is going to continue to ease. They're going to ease aggressively, and they'll probably over-ease somewhere into the second quarter. And that's, between the first quarter and the second quarter, that's where I'm looking for not only the housing market, for the U.S. economy to bottom out.
All right, well, that's a very optimistic view. Go ahead, Quentin, if you may. You always may. Please, jump right in.
All this volatility, all this roller coaster movement has made you guys a little dizzy. You're about 10% off the all-time high. Terms like seller's capitulation come after titanic losses. The fact of the matter is it really hasn't given up that much. If this is a bear market, you're going down to about 11,000. That's 20% classic terms of a bear market.
And if it isn't, then it's a 10% correction, and then up from here.
Yeah, well, you're already off. You're already in correction territory, and fourth quarter earnings are now ancient history. You've got to look ahead at what's in store for the next 2 or 3 quarters, and the market is not yet priced to recognize those declines in growth rates at minimum, declines in earnings at worst.
Go ahead, Jerry.
In the post-Sarbox era, these earnings, this guidance is always going to be low ball. And We just have to get used to that. Everybody always plays it down, and then there's always a surprise to the upside.
Jerry,
you go to jail for getting it right.
Spend.
You have to go under right.
By the way, I don't think consumers, this was a sloppy number, but November was a strong number. You put the thing together. Fourth quarter of 2007 over fourth quarter of 2006.
Okay, what was the good news on Citigroup?
How you want to measure these things? The thing was up at 5%. You've got the chart on the screen. It's almost identical to what it was up last year. Everyone knows today it was a lousy number.
And it's almost all housing materials, too.
Right,
There's a 3% decline in housing materials.
That's right. And actually, interestingly, Jerry Bowyer, good for you, buddy, furniture actually was up 0.6% for you bears out there.
Don't even look at those December numbers.
That kind of laughter, that's a nervous, hysterical laughter there, my friend Quentin. I don't know. There's other evidence. This is a global move, but interest rates are coming down in the United States, Jerry
Okay,
Bowyer.
Larry, I'm ready for the positive on Citigroup. How'd you like that little fact
I'll
today?
give you a positive on Citigroup. I think this is balance sheet rebuilding and repair. And I think that all these banks, whether it's Citi or Merrill or Bear Stearns, they're raising capital.
How'd the stock do?
They're scoring their loans. I understand that. But you know what? Investors who are watching this ought to have some longer-term view than
no
just
question.
what the
They
traders
should
did.
hang back for 3 months, take a long-term view after
Maybe
that.
so, but nobody is smart enough to know that. That's my point. I'm a guy who looks at the basic fundamentals of the economy, and I see good things happening, including balance sheet repairs. Andy Bush, I want you to come in on this point.
Well,
I want to ask you, too, in the money markets, we're going to put this on the screen. The LIBOR rate has suddenly fallen below the Fed funds rate. The TED spread has narrowed in these markets. We are on the E. In other words, the credit stress is at the very moment that Stephen Abrams is jumping ship. The credit spreads are getting narrower in the short-term funding. The Fed's decision to ease has been made, and banks are taking significant steps to repair their balance sheets, even though some people might not be happy with the speed. The reality is things are improving, Andy. Go ahead. Take it from
Well,
here.
and that's the thing. The 3-month LIBOR...
Let Andy answer the question.
Let me answer the question. Okay, the 3-month LIBOR spread to OIS, overnight index swaps, which is the approximate for the Fed funds, that had blown out to 90 points during the August-September period. Prior to that, it was only like 5 to 10 points in a normalized credit situation. Today, we fell down to about 40. That's great, because the lower that goes, that means the cost of funding for these banks is getting reduced and that banks are more likely to lend to each other. A more normalized credit situation is developing. So as we keep going down that spread, that's a very positive development. So that's something I would really keep an eye on and would give me hope for the rest of the year.
And Stephen Abrams, Dougie Cass comes on this show quite a bit. He said this the other night on this program. He's written it up for TheStreet.com. He says, buy the financials. Yes, comma, buy. And he works through a lot of the points that I've been making, including the balance sheet repair and the diminution, the easing of the credit strains in the money markets, the very things that I was very worried about, whether it's asset-backed commercial paper or the LIBOR problem, LIBOR denominated in euros and pounds as well as dollars. Now these things are easing. Some of these central bank liquidity activity is taking hold. There's much more to come, Stephen. Here's this guy, Cass, almost a perma-bear. He's saying buy financials.
I don't disagree with Dougie's view, but the balance sheet repair isn't over yet. In fact, in the case of Citibank, the markdowns haven't been fully taken yet. And this will not be a V-shaped recovery for the financials. A year from now, you'll be very happy you bought some of them, but for the next 6 months, there's going to be a lot of pain.
You know, Larry, they're doing exactly what we asked them to do. They've got new CEOs. They're putting stuff back on the balance sheet, and they're telling the truth. That's exactly what we wanted them to do. That's a step forward.
And Quentin Hardy, on the way out, you all are coming back, but on the way out, have you given up on the global boom? Because tech is tied to the global boom. Have you given up on the global boom?
No, I have not given up on the global boom. I do think this is a cleaning out of junk. And, you know, just when I was done processing that line about acting relaxed for Mitt Romney, you guys start trundling out stuff about credit spreads getting back to normal. Well, let's stay in the real world where there's like consumer behavior. You think this is all fixed. Fact of the matter is, you got all those adjustable rate mortgages coming up in the next year people have to swallow. Citigroup shows up today with personal credit card problems. That's new in the mix, and it could be a bear. There is a lot more house cleaning yet to be done.
You don't think credit spreads have anything to do with consumers?
Yeah, banks, that's crazy.
I mean,
That's the key,
credit spreads
that's the key component. If banks can't get their money costs down, then they're not going to be able to lend to consumers.
If consumers are looking at higher prices and already tightening their belts, they won't spend. Consumers drive this market lots more than bank rates.
But I would just suggest to you that as the Fed funds rate and the European rate and the British rates come down, let's just stay here at home. We know the Fed funds rate's coming down. Bernanke signaled as much. That's going to take a lot of pressure off those adjustable rate mortgages. And I also want to say, even though I've said this a million times before, ARMs in the subprime area is a small fraction of the entire mortgage market, for heaven's sake.
And what's the mortgage rate right now anyway?
Most of them are tied to LIBOR, Larry.
All right, we're going to come back.
Most of the ARMs are tied to LIBOR.
I agree. I'm saying,
which is coming down.
Fed funds and LIBOR ending kind of moved together over a period of time.
Fine.
Yeah, funny how that works.
We're going to come back and talk about the health of business. You guys have all been talking on the demand side. I want to talk about the business side. Our panel's going to stay with us, but we've got someone